A family is a basic unit consisting not only of its members, but it has got its own culture, lifestyle, spending habits, aspirations, and ambitions. This family derives its income from certain sources like occupation, profession, business, past investments made, and assets already created. This income can be used for four distinct purposes. Number one, to meet the living expenses, which is basic. Number two, for creating certain assets like a motor car, a residential flat, a house, a farmhouse, and the like. And the third, for celebrating the wedding of sons and daughters and for their higher education. And finally, for post-retirement life. If a family spends all its income only for meeting its living expenses and left with no saving, such a family will be put to financial hardships sooner or later. So it is important for every family to save out of its gross income. In fact, it can set a target like 20%, 30%, even up to 50% of its gross earning as a saving rate of the family. In fact, when I was young, my boss advised me to save 50% of my gross income every month. Such a target enables a family to not only grow richer but also to take care of its financial health in future. Of course, one must remember, when you save, one must be careful to see that there is no compromise on the quality of life and the standard of living. To do this exercise, a simple, useful tool which is known as preparation of a family budget is very helpful. This budget can be prepared on a monthly basis, and this can be made very flexible depending upon the structure of the family. But this family budget consists of 4 or 5 important components. A family can design its own budget. The first component consists of the gross income. That is the income that the family derives from all the sources. This is the gross income. And the second component is certain deductions are always made. Deductions like income tax, profession tax, pension, and the installment payments on some of the loans raised. All these things will account for the deductions. And gross income minus these deductions will become the net income or the cash flow for the family. This is what is at the disposal of the family to meet its living expenses and also to make its investments. As I already said, if the family spends all its income only to meet the living expenses, it will be left with no savings. These living expenses include expenses like food, clothing, recreation, travel, power and fuel, and the like. If a family makes an income of 1 lakh rupees a month, and if it spend all the 1 lakh rupees on just meeting the living expenses, its saving will be zero. On the other hand, if a family out of its 1 lakh income can save something like 20,000 rupees, that means 80,000 to meet the living expenses, this 20,000 can be profitably invested, employed, which would be helpful for the future of the family. So the next component will be to identify very clearly the living expenses item by item, and all these things must be forecast. A family does a budgeting exercise, and the last column will give the saving, how much the family is able to save. The purpose of this exercise must be, if the family's saving is zero, it must make some saving at least. If the family is able to save 10%, it must try to increase it to 20%. If the family is able to save 30%, it must aspire to make it 40% in course of time. As the family's income increases over a period of time and as the saving rate also increases, I think the family will have potential to meet all its demands in the future. There are two ways of doing this. One, let us look at the income side first. When a family is able to make income of 1 lakh from certain sources, the family can now focus on the potential of the family to enhance its income. There will be certain resources which are not fully utilized. There can be unutilization or underutilization of resources, both human and physical. So a family must now analyze very carefully whether all its talents, skills and resources are fully utilized, and if there are gaps in this, the family must try to endeavor to make it increase it over a period of time. So one exercise the family can take up using this family budget is to enhance its income from year to year. Number two, the family can now focus on its expenses. The expenses must be curtailed as the family moves from month to month or year to year. So when a family spends money on food, clothing and the like, the focus is on can some of these expenses can they be reduced. And one way of doing it, there are a few ways of doing it. The first way of doing this is, are there wasteful expenses in the family? No family can boast and say that there is absolutely no wastage at all. Every family indulges in wasteful expenditure with its own knowledge. So the first thing the family must do is identify all those areas, very clearly say this is a wasteful expenditure. A wasteful expenditure is one, even if you do not spend money on that, nothing is lost. So wastage on food, power, fuel, travel, all this can be very carefully identified and the family must cut these expenses. Number two is to rationalize these expenses. That is where 1,000 rupees is spent, the family can now work out, can you spend only 500 and derive the same benefit? So every expenditure can be brought under this kind of rationalization exercise. And the third one is using alternatives for meeting any of its needs. This is what is popularly known as zero-based budgeting. If you want to have a leisure, a good pastime, the evening to be spent well, one way is to go to the beach, which is costless. Another way is to go out for dining out, which will mean a few thousand rupees. So a family periodically can analyze all their alternatives and it must choose the best alternative, which means the least expenditure but the best results. So by doing all these exercises, the family will be able to reduce its expenses. So by enhancing its income on the one side, by carefully utilizing all its unutilized resources and the talents and the skills, on the other side, cutting down all its expenses which are wasteful, rationalizing the expenses and using alternative methods, the family will be able to see there is saving in the family. And this saving must be made to grow from time to time, and once it becomes a substantial amount, it must embark on a very powerful investment plan, which perhaps is a very important area in personal financial management.